So, welcome everyone to this Capital HQ Masterclass session where we have the privilege of sitting down with Simon Brendel, Associate Partner at Philipps Byrne. Simon brings a wealth of knowledge and insights into the dynamic world of tech investing, from seed funding to major M&A transactions. Simon's expertise spans the full spectrum of the tech ecosystem. Today, he's here to share his experiences, predictions, and strategies for investing in tech, offering invaluable advice for investors navigating this evolving landscape. Join us as we delve into the intricacies of the tech investments with one of the industry's leading minds. Welcome, Simon.
Thank you. Thanks a lot for having me. I'm really looking forward to this conversation.
Fantastic. So look, before we dive into the intricacies of tech investing, could you share with us a bit about your journey that led you to becoming an associate partner at Philipps Byrne and what drew you to focus on venture strategy, technology, and innovations within this role?
Very happy to. So I was initially studying liberal arts. I wasn't a lot into the business world, and I was doing the typical internships, so banking and consulting, the stuff you'd normally do, right? And at some point I realized that maybe that's not for me because you can't really move a lot of things day to day or operationally. And I went into the startup world. I was with a startup in Munich. I'm also from Munich. And we've built a marketplace to rent construction machinery. And that was actually where I really felt I can move day-to-day operational tasks, not like in banking or in consulting at the big consulting firms. And we built the company out and it was really great. We hired a lot of people. We raised a lot of venture money. And that's also how I got into the whole venture private equity ecosystem. And I was also responsible for the whole product side there. So kind of that was also my intro to tech. And then after a couple of years and around 25 million venture money raised, I realized that I'm more of a builder, more of the early phases and actually building the company. And then we had around 100 people. And I realized I'm not a manager so much and handed over to other people and actually was looking out for what I want to do next. And I was actually about to go into an investment role, but then realized I want to focus more on the tech side of things, similar to investing, but more tech heavy. And that's why we scaled Philipps Byrne over the last years, which is a tech advisory company where we go a lot into transactions with investors, with scale-ups on tech side and advise them how to build the best products, how to be the best tech companies possible.
Yeah, so you wanted to be a big cog in a smaller machine is essentially...
That you could also say that, yeah. You could also say that, and also still be a bit more technical than the average, because we're not doing finance advisory, not really look into finance. We just look into tech, and that's what I wanted to learn more about, as I feel that tech is moving the whole investment scene over the next 10, 15 years.
Absolutely, and we'll get into that. I think it's going to move the next 10 or 15 years, and it's moved significantly in the past 10 to 15 years as well. So look, having been at the forefront of guiding significant funding and tech assessments across Europe and beyond, how has your experience shaped your perspective on the tech ecosystem?
And it was quite interesting because in the last years I now was involved in about 100 transactions from all sides. So really small, as you said, really small seed transactions, but also then really big fundraisings and also M&A private equity transactions. And first of all, and obviously if you build your own company, that's not what you see, but the variety is really big. So in Europe, you have such great software companies, but you also now start to have all these crazy deep tech companies, all these great innovations coming out of Europe of all the different centers. And tech is not like one bucket where you can fit everything in, but it's so diverse and it's so great, the tech ecosystem we have. And that's a really cool learning. But then you also see that a lot of the companies also across the fields are very similar in the topics they have across the different stages. So a lot of the seed companies, whether it's software companies, whether it's deep tech companies, have similar challenges, and also across the stages, Series A, B, growth stages, and then also in M&A, questions typically do not vary so much across the different segments. And then obviously you have also a time horizon in my learning. So I started with before COVID basically, and took the whole COVID down in the beginning of 2020. And then we had the last couple of years, we had the craziness before. Now the last 1.5 years, the whole venture ecosystem was down and saving a lot. So yeah, there was a lot of shift, and also how you scale your tech company and how you plan for it.
Yeah, absolutely. And I at Wholesale Investor, we work with seed to Series B companies and tech predominantly, right? So what we often see is what we've seen recently. So I joined in the summer of 2021, right? So that was the peak of
It was
venture
exactly
investment, right? But I only saw 3-4 months of it, and then it started going down. And what we found is that now it took a while. It took maybe a year before the shift started happening in the founders' mind space. In that they are now all about sustainable growth and profit, right? I'm sure we'll touch on that. Maybe you can talk a bit about that in terms of that evolution, especially since COVID, especially since 2020, perhaps after the down that we had at the start because of COVID, and then after it started picking back up.
Yeah, I mean, as you said, like there was this down where it was all uncertain. We didn't know like what is even a lockdown, how does it work? I mean, that was still the crazy times. Like, how does this all work? What will happen? Are we all gonna die? But after a couple of months, everybody realized that it's probably the biggest push for digital innovation, for everything digital in general that you might get. And so venture was pouring in a lot, and also obviously we were still in a zero interest environment, so fundraising for investors was a lot easier. And then we had 2 years of absolute craziness, or 1.5, 2 years, around about, however you define it, where basically everything was about growth, even at all costs. Also in tech, you would just try to grow no matter what it takes.
Yeah.
And also, obviously, we had it in advisory, so it was never about how to be more efficient, how to refactor your code, how to scale efficiently with the resources you have. But the solution for every problem was we just put in more resources because we can get more resources, right?
Yeah.
And a lot of companies were doing that also then into 2022, as you said, in like summer 22 was a bit of the breakpoint where the first fundraisings were going slower, interest was rising, and also GPs had a harder time in fundraising actually. And then it was kind of a dragging out effect, where all the companies now realize slowly but surely, hey, we might not get as much money fundraising further on, so we have to be more efficient with what we have. And that's also the main theme then of late 22 and the whole 23 is actually like, we have to be efficient. We won't fundraise. We may do a bridge round internally with existing investors, but we will probably not fundraise. And if we fundraise, probably not at the existing valuation or with a lot of structure in the deal. And so basically in 2023, also the advisory projects, all the mandates were actually like, okay, let's imagine they don't get more resources on tech. How can they scale efficiently? Or can they even scale efficiently with the existing setup? Or is there so much tech debt, so much challenges on tech that they might have trouble scaling into, for example, enterprise segment or larger clients in general, or even just higher margins?
Yeah, absolutely. And coming back to to what you guys do at Philipps Byrne, you work with both the investor side, right? With clients, that's really remarkable. Axel, Early Bird, and then you also work with the startup side. How was the feeling? How did you realize it pretty quickly that the investment flow and the investment time was getting longer, or was it really when the general market started realizing it?
No, we realized it actually pretty quickly, to be honest, because I mean, we are at a pretty interesting spot because the investors typically come to us when they sign a term sheet, and sometimes even earlier when we discuss certain industries or verticals and whether an investment there is interesting or what company in a certain vertical is interesting. So we were in a pretty interesting spot because we started noticing that the investor interest is basically differing a lot from our initial forecast. There were just no investors coming to us, and you have the venture world is really cyclical. So you have this down in January, and you have this down in summer, and that's quite typical. And basically in August, you can't really reach an investor. You will hardly reach any investor in August. And that's quite normal. We know that. And there's also no inbound from investors in August or in January, typically, or very low. But then over the whole spring in, for example, 23, there was literally virtually very little inbound, and it was totally different from what we normally experience. And we realized that also for the whole year then, there's a lot of down. But vertically for us, or happily for us. What happens then is obviously there's a lot of M&A coming up and a lot of private equity investors, because if companies can fundraise but need cash, they are looking for other methods of exits or even of investment.
Yeah.
And then private equity is getting involved, maybe even an M&A consolidation in a certain industry is happening. And that's also where we act as an intermediary between these investor types and the company.
Great. And look, reflecting on all those challenges within the venture and tech scene in the past year and a half, 2 years, what key factors do you believe will drive the European tech ecosystem in 2024 and beyond?
Yeah. So, I mean, one thing that's very certain, and that's still quite a big push on the industry, is the whole deep tech topic, deep tech industry vertical, however you want to call it. And that's basically not only deep tech. I mean, there's all these studies that you get a better return in deep tech, and it is the way bigger market and everything. But the underlying topic is that the industries that deep tech is normally pushing into, or deep tech companies are normally pushing into, are just industries on the rise. I mean, it's climate, it's the whole impact climate topic, which obviously we don't need to argue about that. It's one of the pressing topics of the next decade or even 50 years. The same about the whole military sector, where deep tech is often moving in. We've now seen that military investments have been a little underserved in the last years, and a lot of funds, a lot of private equity funds, a lot of venture funds are pushing into that segment because they realize that there's a huge return and huge upside there. And then there's also a lot of governmental money flowing into it. So we have a lot of subsidies and investment support. And that's basically pushing the deep tech side. Subsector of deep tech and venture, I'd say, is the whole AI topic. And yeah, also they are driven by the US, driven by the great innovations there on the whole LLM, but also on the semiconductor side. That's a huge topic and will drive the whole venture segment. So all the layers, all the different stages in the AI process are just pushing like crazy, and will drive a lot of venture push. And then subsequently, that will also, again, AI will enable a lot of business model innovation in different segments where you will see venture. So all the big old industries will be challenged by AI, and there will be young challenger startups going into whatever industry, old vertical, combined with AI, especially where you can gain proprietary data. So one big segment that we are seeing, one of the biggest industries, is generally health tech, and also industry where you can do a lot with proprietary data. So you can get a lot of data in health, and from that data you can then again gain competitive advantage with AI. Similarly for manufacturing, just a very big industry, predictive maintenance, QA, for the product you manufacture. And there's also a lot of potential for AI happening.
Absolutely. And I think, talking about the couple of pieces there from what we've seen last year in terms of the data of the companies that have successfully raised capital on our platform, etc.
Yeah.
A lot of, first of all, it's lower than it was in the years before. I think that's just general market.
Yeah.
When I joined, fintech was fintech was, as long as you put fintech on your thing, you were raising capital pretty much. Yeah. That's an overstatement, but you get my point. Last year, what we saw was obviously a downturn in everything, but the two that really spearheaded is climate tech, green energy impact. And the second one was agriculture comes into that. And the second one was med tech, health tech. Huge amounts of that, whether you're a medical device or whether you're pioneering maybe new research into drugs or even new treatments. It was really impressive. And last year I was looking at trying to get speakers for another event, and I came upon NATO Innovation Fund, with 1 billion euros. So I think that's also their push into, I don't know exactly what they do, right? But I can only assume it's a lot about deep tech for military purposes and probably other things.
Exactly.
Yeah. But look, let's talk a bit more about deep tech and AI in general. So maybe what would be great is for a bit of a definition of deep tech from yourself and what you consider deep tech, because online and people have varying definitions. So it'd be great to hear about what you think is deep tech.
Yeah, I mean, that's one of the big questions actually. What is deep tech? And a lot of the investors also, is this deep tech? So what we typically consider as deep tech is if there's considerably IP built within a company. That's actually, I mean, if you build a software company, especially if you build a SaaS company, you might also build IP, of course, but typically in the standard SaaS company, also in the standard fintech company, in the standard software company, there's not so much of IP that could be patented that is actually proprietary involved. Of course, there's exceptions to this rule, right? But what we typically consider deep tech is something that could be patented, may not be patented because of the bureaucracy around this process and the lack of speed involved, but could be. Quite often it's also a spin-off from some sort of scientific organization, can be the case. And that is what we typically consider deep tech. And again, this can be, of course, in software. So a lot of the AI topics, a lot of the machine learning topics are spinning out of scientific innovations, but can also be in all kinds of software hardware combinations. So IoT, we've done a lot of autonomous driving also, autonomous driving cases, and there it's quite often the case that it is considerably IP involved, and that's what we consider a deep tech company or a deep tech case.
So considering that and what we've talked about, there seems to be some sort of resilience in the deep tech field amidst everything else that's maybe contracting. Yeah. So why is that? Like, what unique value propositions do deep tech startups offer to investors and to the general market?
Yeah, I mean, what I just said, if you have certain proprietary IP, or if you have IP that could be patented, normally that also means there's quite a moat in the company you're building. So typically in traditional software cases, the moat is more in your customer login and in the go-to-market you've built, for example, and then the customer go-to-market expansion. But if you have such a deep tech case that is evolving around certain IP, your competitors have to first build this IP or get their IP on their own or better IP. And that's a strong moat you're building in your own. So that's helping a lot of the deep tech companies once they have it. And then also the other cases, there's a lot more capital needed to build this IP quite often. So deep tech companies are normally more capital heavy. But that also means if you have built a company above that threshold, if you have built that moat, it's way harder to just build another company in the exact same space, because investors will just say, okay, they already raised whatever 50 million, build this IP. Why would we fund you doing the same if you again have to build the IP? So there's a very different risk profile. And then there's a not so much technical factor, but often deep tech companies, as we just said, come with less cyclical industries. So the whole climate, the whole agriculture, the whole medtech. This is just industries that will always be working, even if, as right now, the economic climate is a little bit down. A lot of the companies that the deep tech startups are serving, a lot of the industries that deep tech companies are serving are just less cyclical and better markets or better companies to sell to than the typical software SaaS company.
Yeah, so more long-term and sustainable in terms of what the output they can do. But look, you mentioned moat there, right? Which is very important for deep tech. I was wondering what the value when investors look, right, for SaaS companies, fintech companies, a lot of the time they come back to product market fit. Is there product market fit?
Exactly.
I'm sure it's the same for deep tech, but from what I hear and just general feeling, and this might not be the way to go, right? But it feels like the moat of a deep tech is almost as valuable as product market fit for investors. Is that the case? More so maybe than a SaaS or a fintech?
Yeah, exactly. So in the early venture stages with a deep tech company, it's quite often the question, not like, does it fit into a market, but can you actually build whatever they have in mind, also at scale? So can you actually build this fusion reactor or this rocket engine or this semiconductor manufacturing machine or this medtech device? Is it actually from the theory and the IP and the patent they may have, is it actually buildable and scalable as a venture case later?
Yep.
And that's, in a SaaS company, you just don't have this, or in a software company, because you can build most of the stuff with software that's envisionable, right? You can just build it, just needs time and resources. But for a deep tech company, you have this way more often. And then again, this, if you cover, or if this technical risk is covered, then you get to the market risk. But normally the assumption is that the market for the deep tech companies is secondary. There's way more the question about for technical risks and whether you can build it, which again gives you this moat that we spoke about.
So this leads very well into the next topic that I'd love to talk with you about, you know, the role of due diligence in all of this, right? Because product market fit obviously takes due diligence, but I think from a due diligence perspective, if you look at the numbers, if you look at the team, it's probably easier to find whether a company has product market fit, right? Whereas that moat, especially considering that moat usually means novel, new, something that's disruptive, something that people, general investors, or even technical investors might not necessarily understand, right? So from that perspective, what kind of framework should investors employ when looking at a new deep tech company that has a new moat?
Yeah. So, I mean, if you speak to, obviously, a new deep tech company, you always need experts from that field to challenge them. And that's in deep tech, especially, that's quite often very hard, because you have there's these funny cases where it's like a really, really innovative deep tech company, and then you realize, okay, they are pioneering this concept, and there's maybe 10 people in the whole world who actually understand this concept deeply enough, because it's a really new scientific concept. And obviously you need one of these 10 people to actually DD the founders, and the founders is probably 3-4 of the 10. So that's a quite interesting challenge in deep tech, is really going into what they have built and understanding deeply where the technical innovation they want to pursue or want to build is involved. But then also you can there's certain standards across companies that you can involve, and quite often it's repeatable in whatever you're looking at. So there's a lot of AI cases that are similar. There's a lot of innovative cases that are very similar also in IoT, in the whole software hardware connection cases. And quite often it starts with the team. So you really challenge the team. You look in what they've done over the last years, and you also look into their plan. And that's quite often also the first thing, how they want to transfer out of the scientific innovation, where you discuss a lot of theory, where you build your IP, into how they want to build it as a technical product with and for clients. Because also the early stages in deep tech is where you start the conversation with your clients, what you normally don't do in the scientific innovation case. And then scaling out how they really want to build it also at scale.
Yeah.
So you really challenge the team. And then secondary, obviously, you go into the product. So you read the papers, if there's papers, you really look into the architecture on the software side. You look into the supply chains and the planned manufacturing, if it's a more hardware product. And you speak to clients. I mean, that's for sure. You speak to the potential clients, maybe even to the people co-involved in building the product, because that's also quite often the case that you have industry partners that you build a product with, is also kind of de-risking, is saying like, hey, we built this rocket engine, you and maybe 5 others are the potential customers for this. Do you want to be involved in building already? Because then you might ensure also maybe with an LOI that you actually want to buy it. Because if there's only like 10 potential buyers in the whole European market, you probably want to go with an LOI first and de-risk building something that they might not need down the road.
Yeah.
And co-build based on their needs. And you speak to them. So that's typically what an investor should do or would do in such cases on due diligence.
Yeah. And you know, I'm sure, well, for the people that don't know, you know, Philipps and Byrne, you guys are experts in this, right? And tech due diligence. Can you maybe share an example where tech due diligence that you guys led revealed maybe critical insights that significantly influence an investment decision?
So what we don't share specific cases and names. That's just one of our golden rules. We never share names. There's some positive case studies on our website. but we never share names, especially not with details of the findings that we had. But maybe I can give abstract examples.
Yep.
So, I mean, there's typically 2 to 3 common pitfalls that also are the same or similar for deep tech companies and for more software standard or standard tech companies. One is, and I've already mentioned that, is actually on the leadership side. So if we do a tech DD, we don't only look at the software or at the product side, but we also challenge the organizational side of tech, because that's quite often a very involved factor if you want to scale your tech. And one standard thing is actually that very early tech leaders or CTOs, they are great builders. They have built the first version of the product. They are the ones that are really, really deeply involved and smart about this product and know a lot. But they might not be the perfect manager, especially not if the team scales. And it typically gets a topic around Series A, where you then ask them, or we ask them in a DD is, hey, how do you plan to build your team out? What is the critical roles you want to hire? And what is the factors you see you need in this team to actually be successful? And that is when they realize that they see themselves also way more in the role of a builder, but not the manager of this tech team. And they might need a transition and a potential new CTO, or they might need a lot of help, coaching, mentoring, whatever. There's certain formats, different formats that are involved here to actually, from being the sole builder of this product, becoming a manager of 20, 30, 40 people, maybe even more in the technical team. So that's a very common thing that we see in many Series A-ish tech DDs, and also where investors need to put an eye on, because having not the best CTO in place for every given stage has a huge ton of opportunity costs, because you hire very expensive talent into your tech. But if they get burned by not having a good manager, this will be very expensive and slow your company down quite a bit.
Yeah. And look, moving on from that, you mentioned already manufacturing, construction, and your recent blog that you wrote, you mentioned that in 2023 we saw more specific deep tech use cases, right? Including in manufacturing and construction through tech. So what should investors look for when evaluating startups in these sectors?
Yeah, so what I referred to in the blog, and that's a mixture between AI and general old industries, that's what I mentioned earlier, is there's a huge lever right now if you have whatever proprietary data. So if your startup or also your old industry company is collecting whatever kind of data that nobody else has access to. And that's quite often the case in manufacturing, and manufacturing is also a big enough industry. That's the same thing in med health tech. And an example for this, as I said, is, for example, all the productive companies and all the predictive maintenance they are doing. Because with AI, there's a huge potential to automate more of this and to use the data and the unique insight you might have across the different verticals, across your clients, to automate the maintenance and to leverage your own investment and be a help to more clients. The same in health tech. Obviously, health data normally is quite proprietary. So if you collect data from your patients, if you have a whatever hospital or whatever patient service, you will have proprietary data, and you can use this data. Obviously, you have to be compliant with certain regulations, but you can use this data to make certain predictions and maybe recommend certain medicine or even supplements to people and build a new business out of this. And so that's what I mean is, in this old big industries, there's a huge potential to build new cases, even as a business model innovation based on the proprietary data many companies have, and lever internal margin profiles by that.
Yeah, and I'm guessing, probably one of the biggest ones, the biggest industry is supply chain, right? That's going to be significantly changed. But yeah, look, you mentioned health as well, right, in your blog.
Exactly.
So it has seen remarkable innovations recently, but yet a lot of it faces a lot of digitization challenges. What opportunities do you see for investors in this space, and how can they assess startup viability effectively for digital health?
So in digital health, obviously, as you said, there's huge compliance needed with certain regulations. Also, obviously, depending across different regions, different markets.
Yeah.
So also means on the other side that your company normally starts in one region and international expansion is way harder. We've done a lot of transactions and due diligences in the UK health tech market, similar in Germany, but moving from one market to another is just way harder.
Yeah.
So first of all, you have to look obviously a lot for compliance in health medtech. That's, I mean, just for sure. It's very critical data. You have to be compliant. You have to be also very secure with the data. Quite often ensured in the compliance. But then again, that's just, I'd say, a hygiene factor that most of the companies have nowadays. But then again, for the second factor, as I said, it's, for me, if I look at a company, there's just no excuse anymore for not having your data structured and usable. So you should, if you look into a company right now, look into what data are they collecting, if so, and or what proprietary data, and is it structured in a way, or could it be structured in a way that's already usable for a certain data product, recommendation product on top of the existing business model. And that's, as I said, a huge lever on most of the companies also in health tech that you could have, and will increase both your top line revenue side, because you can just monetize a new product, you can build a lot of different innovation on it, but could also increase your bottom line, because you will just automate a lot of processes in your existing product based on the insights you get from the data. So that's, I'd say, especially also in health tech, that's my most common recommendation, is look into the data the company is gathering, whether it's structured and how it could be used for add-on business models or business model innovation even.
Okay, and I mean, very good points there. But for example, let's assume an angel investor who might not have the technical knowledge to understand what every data point means or what the data is. How can they inform themselves, or what actions can they take to ensure that they're understanding the market and what the data that a company holds?
Totally fair. So it's also not about understanding every data point. You rarely do that. You quite often don't have the time to do that. But I mean, also as an angel investor, the concepts for this should exist. I mean, if you do an angel investment, it's very early. Probably even the product is not existing fully. Yeah. So you would normally challenge, what's the concept in terms of data the company wants to pursue? Is it kind of sensible? And especially, what is the proprietary data they can or want to acquire with their product? So what's their data strategy? And that's what I mean. Also in the angel, in the pre-seed seed stage, the company should have at least a strategy on this side. They will probably not build it or not build much of it yet, but they should be able to explain what kind of data strategy they want to pursue and what is the proprietary data they want to build it around. And that I can also question as an angel investor and ask myself also, obviously, as a potential client, hey, is this data I would hand over to them? And would the advice, the recommendation they might give from this data be helpful to myself and to my broader audience and customer group?
Yeah, and taking this to maybe the next level, right? So we talked about pre-seed seed with angels. You know, last year when the AI hype was everywhere, companies left, right, VCs, private equities, left, right, and center were just investing in AI, right? And then I spoke to someone who had been doing purely AI investments since 15 years, right? I interviewed very similar to this, and he very bluntly stated, some of these VCs have no clue what they're doing, right? Yeah. So for those strategies, for them, what strategies would you say that they should employ, right? So is it looking to hire in-house, which may be quite expensive? Is it looking to work with a company such as yourself on a need-to basis, depending on the company that's coming in? Yeah. What would you recommend in terms of strategies for them?
So, I mean, I wouldn't say they have no clue, but obviously the pace of the industry is just so fast that you really need to stay up to date. And if you have a, let's say, main job as an investor, it's really hard to stay up to date with all the trends and all the things founders are building. And especially in AI recently, over the last 1-2 years, it's just changing so extremely fast that even we sometimes are challenged to keep up with all the things happening. And so I'd say as a day-to-day investor, you will have a really hard time if you not focus on this specifically. And it's the same thing if you hire specific talent for that. So it's always the question, can this person really only focus on this? And I mean, that depends on fund size and all the different fund allocation topics. But if they can, that's certainly great. And then there's a second topic is normally hiring a third party to do that. And there's different stages. You might also hire just a scientist to do it. There's also scientists quite a lot involved in different, let's say, due diligence cases. But then also at later stages, at bigger transactions, you might hire firms like ours. Just de-risks your individual investment decision, because we see so many different companies across also different investors. And if you are the one person doing AI within an investor, or the very few people doing AI within an investor, you might still be biased by only the companies you see. And we see the company, what we see is that the companies across different investors, what different investors are looking at, how they focus on certain segments, certain technologies. And by that also we are able to de-risk also the internal bias they might have on certain topics.
Right.
I'd say, especially at, let's say, Series A onwards, you try to get a third eye view on the due diligence cases and not only do it internally. And that's also quite often we work with investors who have specific internal people for tech DD, might also have specific internal people for certain DD cases, but they still decide to hire us on that case and have us cooperate with their AI person, with their IoT person, because we just have another opinion on the company, on the industry.
Yeah, makes sense. And look, moving on to leveraging data and AI in investment decisions, not looking to invest in data and AI, but leveraging those tools. How do you integrate data analytics and AI into the investment evaluation process? And what, let's say, what advantage does this bring to your clients, but also to you?
Yeah, so that's actually, I mean, a very huge trend across investors. And also one of the reasons why investors should hire internally is automizing and leveraging the process of the investors and of the investment themselves. And for us internally, there's two stages of this. So on the one hand, there's basically just optimizing and automizing the process we are having in an investment, or in investment due diligence. And that's basically just increasing the speed and the efficiency of the process. That's also how clients benefit from it, is they just get a better and faster process in
operational efficiency then.
Operational efficiency, exactly. By running certain automations, by running some analysis, for example, on the code level, on the security level, on an automated basis on a company, by also being able to run outside-in checks on companies on certain topics. We are able to speed up the process of such a due diligence. And for example, in a Series A case, need maybe 1.5 weeks for full due diligence on a company, and probably bring that even down to 1 week within this year. So that speeds up the whole process for all people involved. And then the second side, and that's the way more interesting, but also way harder side, is, again, investors are players with a lot of proprietary data, as everybody. And so the same is true for all the due diligence players for us. The main challenge here, again, lies in how can we structure this data that we get from other DDs, from the industry insights we have, how can we structure that? Also, again, being compliant with the laws, and it wouldn't be great if we just share data we get in a due diligence with other parties, right? Then we would be out of business tomorrow. But doing that in a way where we can generate benchmark insights, for example, across all the 150, 200 Series A DDs we've done, and leverage that to give you a view on your specific company you might invest in. So we've done whatever 50 companies in a certain industries, a certain industry across the different investment stages. And they can tell you, hey, for a Series A company in, for example, fintech, they are, or in B2C fintech, they are outperforming on certain tech metrics compared to the typical Series A benchmark of 2022, 2023. And that's where we are going slowly but surely, building this engine to be able to serve this on a broader market. And that's also where investors are going, comparing their whole portfolio to the outside market on a lot of different metrics.
Great. Sounds like a lot of work you guys have got on.
Yeah, for sure.
And yeah, so look, that's the model, right? That's what you guys are building. Now the input, the data that's coming in that context, what challenges do investors face in ensuring data quality, relevance, maybe bias, and how can these be mitigated?
So investors, investors are in a better, or in a good place quite often on getting data, because you in a due diligence, you normally get very high quality data from the company themselves, because you will do an investment, and if it's not a fraudulent case, right, you will get data from the company that's actually proven to be right, and probably even certified. And the same is true with the mass of data being available on outside in cases on certain platforms.
Yeah,
you will be pretty sure that you will get data out of that. Specifically on portfolio analysis, for example, there's one thing that investors need to consider, and that's the whole survivorship bias. So quite often you'd compare to the successful companies you had and their metrics, but obviously that's also only the successful companies you had. And you actually need to build a bigger pool of all the companies, not only the really successful ones that, so to say, survive the growth, and compare to their metrics, because you really want to have an average of the market or the subset you're comparing to, not only the successful companies, to in the end have healthy and usable benchmarks in a way. And I'd say that's one of the biggest challenges, and you can prevent that by just changing your data set in a way or adequately to not only have the surviving companies.
Yeah, absolutely. I think if you just focus on the companies that did really well, it might not just be because of the data, right? It might be because of the team that you mentioned or external factors, and the data of companies that failed might still be extremely valuable. So very important to have that holistic oversight. Look, now looking into the future of VC with data-driven investing, right? Or the future of investing. How do you envision data-driven investing shaping the future of investing, venture capital? And what role does AI play in this transformation?
I think it will play a huge role, and I'm really looking forward to that future, because currently VC investment is still driven by a lot of bias internally. I actually wrote my academic thesis on heuristics and biases within VC and private equity investing. And it was a couple of years ago, but you can still observe a lot of things actually being true and actually happening in the market. And VC will change, AI and VC will change that, because you will just be able to find companies and to analyze companies without applying bias first, especially in finding. Because there's still all the statistics of underserved female founders, underserved minority founders, right? And also then female founders, for example, being way more cash efficient. And it will take years for sure to build up or to catch up the spaces. But especially in the selection process of companies and in the early stages, data will be able to navigate across biases that individual investors may have, way better than just peer pressure, and help in the selection, help in the early stage investment process, and basically navigate a better VC investment based mostly on data.
But so completely see how that could work, right? But the model needs to have as little bias as possible as well, right?
That's one of the challenges. Obviously, the model is being fed by the data that we currently have. and the data is being built in the market with these biases. So you actively have to look into the data set, first of all, what biases might be involved, and also obviously into the model themselves and the decisions. And that's where, in general, not only with AI and VC, but AI in general, a lot of the questions are right now, how explainable are model decisions, the whole explainable AI topic. How well can we explain why a model decides for something, and how well can we detect if there or whether there's still bias within that decision, or how much bias based on the data set will there be in that decision. But I'm pretty confident that over the years you will be, or you will have less biased decisions compared to a human alone, standalone process, investment process.
And this is a bit of a left field question that probably doesn't have much to do with our discussion. It might, but what's your thoughts on synthetic data? There's been a lot of talk about synthetic data. Do you think we'll get to a stage where it can replicate real world data or not?
I think we will get there for sure. I mean, on the one hand, it helps to augment data sets, and it helps to prevent biases in data sets already. And we will also get there to a point where synthetic data might be able to fully replace data sets in the future, but also already augmenting data sets and maybe neglect or preventing certain degree of biases, I'd say is a great advantage and a huge upside of having synthetic data.
So question on like a much smaller scale, right?
Yeah.
With this, do you think a synthetic data set or could reply to a survey for market research and give you an understanding of what the market's looking for?
Probably, yeah. I'd say so. Probably
That's
already is within the realm of what's reasonable. I'd try it out and look into the quality, also try multiple versions of that or variants, but I'd say probably yes.
That's very cool. So look, I'm conscious of time. We have a couple more minutes, but for investors eager to dive deeper into tech investments, how can engaging with you guys, Philipps and Byrne, elevate their strategy in general and due diligence process? And maybe take us through the typical process of an investor joining you guys, what that entails, and what your outcome is, whether it's good, bad, like what's that whole process look like?
Yeah, happy to. So we typically get engaged around the term sheet of an investment. So normally the investment decision for a certain company is already being done. What we also do on a more customer engagement basis is actually discussing with investors certain industries, maybe even certain verticals, and a comparison of companies. But that's typically then on a higher level, because technically you don't have so many insights into a company or on the tech side early on. So that's only basically a high level supporting their investment decision. And we really get involved and into the due diligence once they sign a term sheet with a company, once or are in the final bid round and actually decided for an investment there. And then we start a due diligence process. We discuss the investment thesis. We discuss what they actually see in the company and why they want to invest. And based on our due diligence framework that ranges from the leadership team across the tech architecture, the scalability, the security, to the code level, to the maintainability, we build out a case for that specific company based on also the investment thesis. And we run some automated analysis. We request a data room. And then we dive into the company deeply. We do interviews with certain team members and also get back with the investor during that process. So basically reflect what we've seen, and that often gets interesting if there's a deviance from what the investor has pitched us, or the investor has maybe also defined as the investment thesis, the guiding questions. And then basically in the middle of this process, reflect and say, hey, that's what we've seen. Do you want us to go deep somewhere else, or is this all fine with you? And then we start writing the report. And that's also where we differ the most from typical tech DDs out there, because what we want to achieve in a report, and that's always our benchmark, is not only give you the, hey, this is good, bad, I don't know, performance is okay, because that we found that not to be very helpful also when we build our companies and were DD. But what we want to achieve is give you a benchmark across different topics, how you're performing. So scalability, for example, for a Series A company, you're above market or compared to market, maybe a little bit low in terms of scalability. And then also give actionable recommendations on all the different topics. So we have a huge list in every report. We have a huge list of the topics we found and the issues we found, but also how to prevent them. And these lists are quite often then used by the investor for board decisions, for 100, 200-day plans post-investment. And quite often the CTO also appreciates, or the technical leadership appreciates that, because they actually get a deep sparring on tech, which many investors may not be able to provide on that level. And that's how we typically run a transaction.
Fantastic. Well, it sounds really good. I have 2 or 3 more questions looking towards the future, but I think one that would be very interesting is, you know, you've worked with both startups and investment firms. You do that a lot. What key qualities do you believe define a successful investor-founder relationship in the tech sector, maybe from prior investment to post-investment?
Yeah, so we often say, and I mean, that's, I'd say also from pre-investment to post-investment, quite an important topic is openness. So put your, we always say also that everybody has the skeletons in the closet. Nobody has none. And especially in the investor-founder relationship, put them on the table. Tell the investor what's up, and also be open about the plan you have going forward, navigating them. Because as I said, everybody has them, but investors can be a big supporter in navigating them once you realize that it's way smarter in the long run to be open about them, to tell them, hey, we have this topic, but it's also, we already have a plan to mitigate it. We just maybe need resources, or we maybe need a bit of time to navigate it and to prevent it. And normally, if you run that very well, investors are open to doing that, because they acknowledge that everybody has the skeletons. And that, for me, and that's also what we've seen, helps to build this relationship investor-founder, and often is a crucial part of a successful company and a successful founder-investor relationship.
Yeah, it's on your brochure, the zero bullshit approach.
Exactly.
Great. And you know, as we look towards the future, looking ahead, what significant, maybe give us 2 tech investment trends do you anticipate will take center stage over the next few years?
Yeah, I mean, we discussed both of them already. I'd stick there. So for sure, for me, the biggest topic of the next years is proprietary data. On the one hand, so whatever certain industry vertical you're in, can you gain and leverage proprietary data within that model, and business model innovate on that. And the second topic is also, again, whole deep tech, not only climate deep tech, for certainly a very big topic, very close to our heart at Philipps Byrne, and huge stuff happening there. But then also, and that's very close to my heart personally, there will be a lot of defense, dual use innovation, a lot of deep tech in military use cases that's actually growing and will shape the next couple of years with investment, as you said, also governmental, the NATO, but also the German government, the France government, I think also the UK government are unlocking big money pools for that. Yeah, on the customer, but also on the investment side. And I'm pretty confident that this will be a driving factor in the investment landscape for the next years.
Yeah. You know, you talked about Germany there. I read in the Times this week, the Financial Times, Germany has just pledged its highest ever national budget, right? So we're going towards that. But look, finally, could you share one piece of advice? I know it's probably difficult for sophisticated investors aiming to navigate the complexities of investing in tech in general.
I'm at the risk of being very repetitive.
Yeah.
But again, look into data. Question founders, especially on data. If you have just one, or if I have just one advice that I can give to people is look into the data and the proprietary advantage a company can build out there, because that's the only thing that will not be at risk by AI, by challenger companies, and especially also will help you to evolve your company over the next years, is having certain proprietary data models.
Fantastic. Well, look, Simon, thank you very much for joining us today. It's been an absolute pleasure. And for anyone who's interested in getting in touch with Simon, we'll put different links in the description for Philipps Byrne, maybe to your blog, to different kinds of things that people can have access to. But thank you very much for joining us today.
Perfect. Thanks a lot, Hugo.